everybody. Welcome. I am being responsible and staying home, even from the office. I had a cough and a fever and yesterday and the day before. So I don't think I have coronavirus. Oh, look at Sandy. But just in case, in an abundance of caution, I am staying at home and Maya is at the office. And we are very happy to welcome you to community office hours for Robasciotti and Philipson. And we may do more of these if we find that this is helpful. If we bore you all to death and don't answer enough of your questions, you can let us know and we won't have more of these. But we thought people like to get information and reassurance in a number of different ways. Some people want to read something, some people want to talk one-on-one, and a lot of people in our community like doing things in group format as well. So we wanted to make that available to folks as well. So we're happy that you're here and we are excited to answer questions.
So I'm Maya, you probably all know me, I'm Maya Philipson, I'm Rachel's business partner. I will be monitoring the chat during this call, so I'm going to mostly be putting myself on mute, but if you have specific questions, you can chat them into the chat. I will be reviewing them. And Rachel Freeman.
Oh, I knew I was going to be next. Hi, y'all. I'm Rachel Freeman. I'm the Director of Rise Investor Services here at Robasciotti and Philipson. And I'm also super excited to use she, her pronouns, of course. But then I also am so excited to see 9 women on my gallery view here on Zoom from Robasciotti and Philipson. This is exciting.
Excellent. Renee?
Sorry, I was on mute. I'm Renee Morgan. I use she, hers, or they, them. It's okay. I am the new social justice strategist and have been working over the past couple weeks most closely with Rachel, learning some of our social justice partners, and with Fong looking at the investments.
So let's see, Fong. Thought I saw Fong.
Hi, everybody. My name is Fong, and I'm the investment strategist for our RISE strategies, and I help decide and work with our data partners on what companies we keep in the portfolio, what we don't keep in, so we can maintain our social justice values that we've worked on with our community, and that we maintain with our community. So thank you for being here, and I'm so excited for our conversation today.
Thank you.
I'm ready now. Yeah, sorry, I was on mute. My name's Sonia Dreisler. I consult at RNP and for RISE about marketing and communications and whatever else comes up.
True.
Happy to be here. My pronouns are she, her.
Thank you. Christina?
Hi, I'm Christina Richardson, and I work very closely with Maya and Bela, and I'm a client services assistant.
Thank you. Sandy?
Hi there, everybody. I'm Sandy Holmes. I'm the Chief Compliance Officer, and I also have several responsibilities in operations.
Wonderful. Thank you, everyone, for introducing themselves. If you want to send a question to anyone specifically, I suggest you send them to me. As I said, I'll be monitoring, but there is a way, also I just put it in the chat, that if you want to send a message to me privately, next to the chat, there's a drop down. It says everyone, but you can choose my name if you want to send it to me. I'm going to mute myself for right now and let Rachel start our program.
So I could just start talking I don't know that we have a program. We're here, it's for office hours. So we're here to answer your questions and speak to any of your concerns. And so I just want to start by leaving some space for anyone that has questions to unmute themselves and let us know what your questions are, or chat them in. That also works.
We have a question about moving money to fixed rate CDs right now. So I think it would be great, Rachel, if you could talk a little bit about interest rates and the relationship between interest rates in the stock market and what we've seen overall in terms of the yield curve generally.
Maya, I think you are perfectly happy to talk about that. I can tell. You're already ready.
I do love that. I do love that.
Please, you are.
Will you take over the chat for me?
Yes, absolutely.
Okay, perfect. All right. So one of the things that we have seen in the last couple of weeks is we've seen an incredible amount of volatility in the stock market. We've seen really high highs, really low lows. In fact, we've seen some of the worst days that we've seen since the mid and early 80s. That is interesting because if any of us are old enough to remember the mid and early 80s, you may remember that interest rates at that period were very, very high. I remember one of my clients telling me they bought their first home at an interest rate of somewhere around 14% on a home mortgage. Home mortgages right now are running a little under 4%. What that means is that when you put your money into a bond market, because bonds are basically incredibly fancy IOUs, so you're loaning money to someone, they're paying interest payments, and then you get the principal back. At that point, interest rates were relatively high. And so if you took money out of the stock market as it was falling, you may have had the opportunity to move it into the bond or the fixed income market and get a pretty good return. What's interesting about this market fluctuation and the drops that we've had over the last week is that the bond market has been at really historical lows for quite a few years. The government has kept interest rates at an incredibly low level, which has been great for borrowing, great for mortgage rates, but it means that keeping your money in a short-term vehicle like a savings account or a short-term CD means that you're earning incredibly, very, very little interest on your money. With all of the volatility that we've seen, particularly in the last week, people have been doing that anyway. They've been pulling money out of the market and putting them in things like CDs, savings accounts, short-term money market accounts. And because of the inflows into those types of investments, the rates have dropped even lower. The UK, the United Kingdom, their government bonds dropped into negative interest rates for the first time in their entire history last week.
And what does a negative interest rate mean?
A negative interest rate means that the government is actually paying you to borrow money, which is kind of the best.
Not something that happens very often.
But not something that happens very often. So I personally don't see a lot of benefits in taking money out of the stock market and moving it into something like a CD, because even though stock market returns are falling very fast, they historically do much better than something like a CD.
True. Yeah. One of the things I wanted to remind folks of is that when people are thinking about making quick changes in the way their portfolios are put together in response to this type of market environment, it's usually with the idea that this is a bad time and we'll know when a better time comes. And I just want to remind folks that market timing is really hard. Sometimes it can take over a year to see a rebound, or yesterday being one of the worst days the market has seen since 2008, 2009 can be followed immediately by today, which almost completely rebounded all of the losses from yesterday. So staying with the investment plan that we put in place that understands that we are going to have shocks to the financial markets. All the portfolios that we create all have that built into them, so that over the long run, you can actually withstand this type of market correction is usually the best way to go, because there are very few people that occasionally do well by timing a market, but statistically it's nearly impossible to do a great job of timing it. Almost certainly the best thing is to stay put unless you need the money that is in your account tomorrow and you need it to be exactly the amount that is in your account today. That is one of the only times that actually makes sense to make a move in this type of situation. But if we've been doing our work correctly, you would be almost entirely inside of cash if that were the case. We'd have you at a very low volatility, low risk portfolio if you needed the money tomorrow. So we would have kind of already planned for that eventuality.
Thank you, Rachel. A lot of the questions that I've seen come through that you were kind of talking about was from some of our older clients. And I think that we've had a lot of calls, and we've had some concerns from our older clients, let's say those that are above the age of 60. And you were mentioning that a little bit in terms of, you were talking about people's risk tolerance. That's what Renee was talking about as well, that stomachache factor. But can you talk about how we actually create portfolios that have different types of resilience depending on what type of investor our clients are and what their ages are?
And you meant Rachel Freeman, I imagine you were trying, or were you
I
wanting me
actually
to
meant
talk?
Rachel Robasciotti, but I would love it if Rachel Freeman, do you want to answer that question, Rachel?
Well, you didn't say Freeman at the beginning, so I was listening. I'm happy to answer that question.
Please go forth, Rachel Freeman.
Yeah.
Go
No,
forth,
and that's great. Okay, what was the question? So yeah, no, thanks I'm happy to piggyback on what Rachel was saying as well, Rachel Robasciotti, OG Rachel, as we call her in the office. When we're looking at your portfolios, especially clients of Rise, and from younger sort of accumulating your wealth over time and also then getting to your retirement stage. A lot of our asset allocation that Rachel mentioned before is all based on a couple of factors: risk expectations, time horizon, and objectives. So that's why we have, real relationships with our clients to really get to know you, get to understand that about you. And then we design portfolios based on that has a good balance of equities, in the stock market, and then bonds, as Rachel and I were talking about in the beginning. So a lot of that helps balance out some of the volatility. And I was going to ask at the beginning of this call, who paid somebody to get the market to look like Charlie Brown's t-shirt? Because it came back up today, and how Rachel and Maya timed that just perfectly before this call. But good job. It was probably Astrid.
Doing our part.
Yeah, exactly. Great job. But that's how we build the portfolios, to really balance out that volatility and focus on your long-term goals.
And Rachel Freeman, that's a really good point, is that what you're seeing in the news isn't necessarily what's happening in your specific account. Frequently, when the news is reporting, they're reporting on what's happening in the Dow Jones Industrial Average. And just to give you a heads up, that is a collection of about 30 companies and how they're performing and how they're responding to different market conditions. And so you can hear some pretty wild things about the Dow Jones Industrial Average because it's only 30 companies and there are literally thousands in the financial markets. So just bear in mind that what you're seeing in the financial markets on television is probably not what you're seeing in your portfolio. Your portfolio is a lot more diversified, most likely, than that, which helps us to balance out some of the rocky times.
Thank you, Robasciotti. Thank you, Freeman. Rachel Robasciotti, do you want to talk about pooled investment vehicles and units? And because we have gotten some questions about people seeing, who are getting closer to retirement, a little bit older, seeing the value of their portfolios go down. But do you want to talk about sort of units of investment in something like a mutual fund versus investing in like a single share of a stock?
I think I'll monitor chat while you answer that question. I'm getting a pretty good ear for when when Maya actually knows the exact thing that she once said. So I'm just going to monitor chat while you take over and answer that question.
Sure. I did have questions about it. Okay, so one of the questions that we got is, what happens to a portfolio that reaches a zero account balance and the shares that they are tied to? So I want to talk more specifically about investing in stock versus investing in some sort of pooled investment vehicle like a mutual fund, and what owning shares of a mutual fund means. So when you have an individual share of stock, how well or poorly your individual investment does depends entirely on how well or poorly that company does. And so investing in an individual company and their stock is generally seen as riskier than investing in something like a mutual fund. The way that mutual funds work is they take lots of shares of lots of different companies, they package them together, and they give you a share, and that share represents holdings of many, many, many different companies. One of the things that tends to happen is if you're invested in an individual share of stock, and the market goes down, that particular company could go down farther than the overall market. And so your portfolio could be artificially depressed because that individual company did not do very well. If you're holding that same company but within a pooled structure like a mutual fund, that's just, that company is just one of the holdings amongst everything that you're invested in. And so your account, while it may go down, is likely to not be as depressed nearly as far.
Okay. One thing that people have been concerned about that we've heard about is that the Federal Reserve, which is our central bank, has been putting money into the economy, and that can be a sign that they are worried about what's going on, and that's true. It's one of the reasons we have the Federal Reserve. The Great Depression scared a good many people, and we thought it was a good idea to have central banks to help manage some of those big ups and downs. And the Federal Reserve put more than $1 trillion into financial markets. They mostly did that by buying up bonds. And they have a number of different ways to kind of inject more money into the financial markets. The reason why folks wanted to, or the reason why the folks at the Federal Reserve wanted to inject money into the economy is because in the current crisis, people are so wanting cash that usually when stocks are not doing so well, bonds are doing a lot better. But when everyone's just trying to get a hold of cash, both stocks and bonds won't do as well because people are just kind of cashing them in. And when many people are doing that at once, and that it happened in another format during the 2008-2009 downturn. That's when you get a situation where the Federal Reserve may need to come in just to make sure that markets keep functioning. They did that. And it looks like markets responded rather well to that today, as well as the federal government doing some things around coronavirus relief for American people, which is really wonderful.
Rachel, we have another question about liquidity. We have a question about, is it a good idea if you already have liquid assets to keep money in cash?
So that's a really interesting question. We've gotten that question many times over the years. Generally speaking, when you have a large liquid sum of money and you intend to invest it, one of the best things that you can do is invest it in smaller chunks over time. One of the reasons why that's particularly useful is that if you do that over the period of time that you're investing, you generally aren't getting the best or the worst price as you're buying in. You're generally getting an average price because you're buying in over many different days, something that we call dollar cost averaging. So if you were going to be in the market and you were investing over many days, and this past couple of weeks happens to be some of those days, it's possible that if you've been buying in, like, let's say, for example, with $100 a day, your $100 may end up buying more shares on a particular day, like yesterday when the market was down. So you might end up finding that happened. There are people who want to take advantage of that. And there are people who, if they have cash on the sidelines, they're like, oh, this looks like a really down day in the market. Everything is on sale. They're seeing that it kind of maybe more the way that we see it. They're like, oh, everything is on sale. And they want to buy at this time when everything's on sale. The only trouble with that is that even though there was a big shock to the market, this may not be the bottom of the market. Who knows? You might actually be buying at a time when it's not as inexpensive as it could get. So that's one of the reasons why we really encourage kind of measured, planned, what we call dollar cost averaging over time.
What about the reverse, Rachel? Would you suggest dollar cost averaging for someone who is short on cash and needs cash, but is afraid of the volatility in this market?
Yeah, you can dollar cost average in the reverse as well. Hopefully, if you're short on cash and need cash, that's something that that we should be kind of planning for in the management of your account. So that's definitely something we can have more of a one-on-one conversation about with different members of our investment team, just to make sure that your account is set up appropriately, because usually we can already have a fair amount of money liquid in someone's account if we believe they're getting close to the time when they might need that cash. But yes, it is possible to dollar cost average in and out in order to kind of spread out the risk that on any one particular day, you're selling out when it's kind of like the worst time, for example. Yep, and you're muted. There you go.
Great. I think that you were really helpful in answering that question. I think that dollar cost averaging is a really wonderful strategy overall. How long do you, when you're talking about dollar cost averaging into the market, it seems like that could be a fairly open time frame. So do you have theories about how long is like a prudent time to dollar cost average in? And then maybe if you're also talking about taking money out of the market, do you have rules of thumb around that?
Well, with taking money out, it's a little bit different. Usually we've been making the portfolio be something that is more able to become liquid. So kind of a portfolio that has less volatility in it. We've usually been moving portfolios in that direction if we know you're going to need money in the near term. But if someone suddenly, needed cash, if the cash is available, of course, taking care of yourself and your loved ones, if there's an immediate need, and it's your money, we can always sell positions that are in the account immediately. But if people can waiting even a week over, selling everything in one day and just kind of like doing a systematic process of selling can be something that's helpful, just to reduce the risk that at any one particular moment, you're selling, selling or buying at the worst possible moment when you're dollar cost averaging. Usually the time frame depends on how much money we're talking about. If people are wanting to take out a very substantial hundreds of thousands of dollars, frequently they'll take a longer to dollar cost average in or out. We've seen clients who've had millions of dollars of cash to put into the financial market take several months of dollar cost averaging. I feel most comfortable with that. But since it's a strategy that's designed to reduce your risk, it's really about how important is it that risk is reduced. And generally speaking, it's a short-term risk because we do know that over the long run, that the financial markets do return positively over the long run. It's usually only ever the short-term kind of impact of buying or selling on the wrong day that we're worried about.
Great, thank you. We have a question about kind of making decisions while the market is volatile. And so just making quick, I have a client who's kind of saying, the market's really volatile right now. Is this a time to kind of change my portfolio even though I'm worried? Do you want to talk about sort of volatility and the worry about making quick changes?
Yeah, I mean, a rule of thumb is that generally when the financial markets are having a lot of volatility, when your emotions about the financial markets are the highest, generally speaking, whether you're very hopeful or you're very afraid, those are generally not the best time to make significant financial decisions about your money, because there's a significant possibility that what's happening is that you've become afraid at a time when other people have already started selling off. I mean, it's kind of like driving while looking in the rearview mirror. So generally speaking, I think it is important to pay attention to our emotions around what's happening with the money. And while it's important to acknowledge those emotions and see how they're playing into things, if we can refrain from acting on kind of like emotions when they're at the extremes around our investment accounts, we find that over time, the people who do best are the folks that stick to a good long-term plan. One thing that people can do, and I think this is just something that happens, we all get worried and we want to do something in times where there's a lot of uncertainty. There is one thing that people who have investments can do. If you happen to be living off of the money in your account and you were going to take out a large amount of money for a discretionary purpose, so something that isn't like where you are, it's not necessary for you to pull the money out. You might ultimately decide to wait a bit until the market's less volatile to pull that money out. I always tell people that is the one thing that you can do. If you need the money on any type of recurring basis, if we're managing monthly income or that sort of thing, generally speaking, we've already done the work that's necessary to make sure that the funds are liquid and available to you. So if you're in that type of situation, it's likely that your account's not having as much fluctuation as you're seeing on the news or reading about in the news media. Any other questions from folks who are here? Or from anyone on our team, if you've had any questions come in the past week that you want to share, we can, sometimes we don't always know what our questions are, but we can tag on to somebody else's question.
Yeah, Rachel, we have a question about opportunities. So what are your thoughts when there's market volatility like this about refinancing traditional mortgages or reverse mortgages even? Is this a good time or a bad time to do something like that?
Well, that is one of the questions that we can give a straightforward answer to, because it doesn't involve looking into a crystal ball or otherwise predicting what the next movement in the market will be. And I would say that if you are someone who is noticing that the interest rates that are available now on home mortgages are lower than the home mortgage interest rate that you currently have, that may be a time to reach out to talk to a financial advisor about whether or not you want to refinance. Because it's possible you can get a lower interest rate. Something to bear in mind, and I think with our refinance, the refinance opportunities that have been out there with this historically low interest rate environment, as we talked about earlier, a lot of us start forgetting that every time you refinance, you reset the clock on your mortgage. So if I have a 30-year mortgage and I refinanced 5 years ago, I only have 25 years left on that mortgage. And when you refinance, you may get a lower rate and your payment may go down, but usually you're restarting the clock unless you go for a mortgage that has a shorter term. So that's something else to consider. And it's one of the reasons why you probably want to check in with your financial advisor to see if that's something that makes sense in your particular situation.
Thank you. I have a really snappy question. What's the deal with oil? And why is hand sanitizer worth more than oil? Come on.
What did you say? Why is what worth more than oil?
Sanitizer worth more than oil.
I love that. I'm just imagining barrels of hand sanitizer.
Barrels of hand sanitizer.
Yeah, and people wanting that more than barrels of oil. Oil is such a complicated situation. It is not that we want to pull more oil out of the ground as humanity, as individuals, or as not individuals, as a human race that has the earth as its only home. We certainly want to limit the amount of carbon that we are pulling out, if not eliminate the amount of carbon that we're pulling out of the ground. That being said, the scarcity with which we as consumers and the world interacts with oil is a bit of a false scarcity. The problem generally isn't at any one time whether or not there's enough oil. The problem is generally that the major producers of oil work together in a cartel in order to limit the amount of oil that's being produced. And that helps to stabilize the price of oil, because if there is a steady supply of oil available and you can charge a pretty steady price for it, you get a kind of stable market inside of oil. However, if any one of those cartel members breaks off or another major oil supplier comes onto the market, then you end up in a situation where a lot more oil is suddenly available. That's exactly what happened. It appears as though Russia has decided to kind of go it their own and step up production in oil, which has brought more supply into the markets, and therefore the price of oil has gone down. Right around the same time, because of the coronavirus, a bunch of us have stopped traveling, and one of the biggest consumers of oil are airline companies. And so at the same time that more oil is being produced, the demand for it is less. And so that's a little bit That's a little bit like being a fish seller who suddenly has twice the normal amount of fish, but you also suddenly have a lot of people who have become allergic all at once. All of a sudden your fish becomes very cheap. That is exactly what's happened with oil. So that's why it's so strange. Hand sanitizer, I know, Maya's looking at me.
I'm allergic to fish.
Yeah, well, you are psychologically allergic to fish. It is true. Maya feels some kind of way about being allergic to fish because she's half Swedish and feels that she should be able to eat fish. I see another question coming in that says, if companies like Zoom are going to be used more universally, are they worth investing in? Do you know if they're a good company according to your screen? When you say good, I think the question is whether or not they are a part of our investment universe or would pass through our investment screens. And I don't have the investment universe. Thank you, it's correct. I don't have the investment universe at my fingertips, though I could, if you gave me a moment and someone answered another question, I can kind of let you know whether or not Zoom is in our investment universe. So that's one question about whether or not it passes the RISE screens. But whether or not a particular company is a good idea to invest in, that's a very speculative way of interacting with the money that we've set aside for really long-term, very important goals, is to, if we try to kind of invest very much in one's particular stock. And we just don't tend to want to do that because that is the age-old problem of putting all of your eggs in one basket, right? If the basket drops, you lose all of the eggs as well. So the idea there is that we give broadly diversified portfolios. And if you are invested in a broadly diversified portfolio and a company like Zoom is in that portfolio, you will get some of that upside. It's not the same as owning a very large concentrated position in Zoom. But that is, that is a possibility if Zoom is in a portfolio that you would see kind of like the portfolio increase. If there is another question, I can actually look to see. We just, we're constantly refreshing the investment universe. I can check to see, and maybe Maya, you were checking to see in the
So I wasn't, but I have a question that Rachel Freeman can answer while you are checking on a company like Zoom. So Rachel Freeman, this is a question that you can answer that is more specifically about RISE and the sort of themes that RISE highlights in our screening. We have a question about someone who feels like some of the things about this pandemic are caused from things like deforestation, not enough global sharing, companies really being extractive of our people and our planet. And so the question is sort of, does the RISE portfolio highlight investments that are companies that can kind of help with some of this? And how do the RISE screens approach companies that act in those negative ways?
Oh gosh, you gave me a big one, Maya.
I know, she gave me a big one. I want to say something about that.
You said Rachel, right? No, that's a good one. I'm happy to take it. I think that ultimately when we're taking a look at the and Rachel, you can jump in here, or Sonia. But I think when we're talking about the RISE portfolios and we're talking about really moving the needle for publicly traded companies, moving into what we hope is not our dystopian future, we would like to really sort of shift, the landscape. I think that, the RISE screens, as our community has developed them, and the issue areas that we focus on are really long-term issue areas, not just within the stocks that we're investing in, but also the areas in the screens that we're applying and looking to actually encourage those companies that fall in that neutral space to move more towards what I think, Davis, you referred to as like good companies, and improve their employment practices and improve their environmental impact. And so I think that, the way that our robust screen is developed, we are looking toward that really long-term time horizon. And Rachel, you want to help me out here? Add anything else?
Well, I have a personal opinion that I am happy to share, and it's one that actually informs what we are doing. I believe that there's a lot of the crises we've been experiencing recently, everything from the historic wildfires that we've seen in our own backyard and in Australia, to the recent uptick in in the viruses that are being transmitted to the human population from wild animals have a lot to do with how we're living our lives, not necessarily in a regenerative way, in a way that's really sustainable long term. And there are some people who believe that in addition to having a values aligned portfolio that not only just reflects one's values, that it's also really a smart long-term move to invest in a way that is sustainable, because eventually those things that are unethical generally end up becoming illegal or lead to worldwide pandemics, for example, and may end up having negative impacts if they're found to be tied to your company. That may sound far-fetched, but we've seen recently multiple cases being brought against the major oil suppliers for climate change, and some of them are moving through the court systems in a pretty successful manner. So there is a belief that in the long term, being a values aligned investor is not only something that is good from a moral sense, but may be something that's good for your bottom line as well. And I just want to make sure that that's answering the question that was originally asked, because I did get on my particular personal opinion about that.
That was answering the question that was particularly asked. And we have actually answered all of the questions in queue, and our queue is now closed. So we can.
Can I add something that I wanted to piggyback really quickly? I know.
Yes, you can.
I'm notorious for this. I'm sorry. One thing that I sort of wanted to mention, just as an interesting thing, I think most of the folks on the call know that we're just a bunch of data nerds, and we're all saying we don't have a crystal ball, we can't look into the future, this is not how we build our portfolios, which I love, which is why I joined this firm and why I love this team, because we're really not looking at making predictions, and we're really saying let's build a really sound investment portfolio for all of our clients, and then really stick to the plan. Something that I was reading about earlier was about how the stock market has performed in past viral outbreaks. And so when we're talking about coronavirus spreading, taking a look at the short term versus the long term, and there are a couple of articles online that we can sort of share with the masses as well, potentially, if Sandy approves. But, you know, just for example, looking at the HIV/AIDS epidemic in a short term, the market crash that happened right at the beginning, but over the long term, the S&P and the Dow, you know, up 8.2% over 6 months, 26.3% over 12 months. Same thing with SARS, up 14% after a crash, 14% up in 6 months, 20% up in 12 months. So all the way down the list, avian flu, dengue fever, all numbers are positive over those longer terms, even after a market crash. So it's just something that when we're talking about short term versus long term and tuning out the noise, that's been really on my mind. So I don't know if that's helpful for folks, but I thought it was interesting and really shows that we just really care about the data and not making those future predictions.
What a wonderful addition, Rachel Freeman. I appreciate that. And I did realize there was one question about whether or not Zoom is in the RISE universe, and I will follow up with the person that asked that particular.
We know who that was.
Yes,
we will
I will
follow up
offline for sure.
Absolutely.
All
Okay.
right. Thank you everyone for joining us. Thank you. Thank you, Rachel Robasciotti, for talking to us. Thank you for Rachel Freeman, Renee, who added to us. Thank you, Fong. Sandy, Bela, Christina, Sonia, Rajat, and all of our other staff members who were able to join us, and thank you, clients. We will see you soon.
We'll see you again next time. We'll certainly do this again if necessary.
Perfect.
Thank you so much.